Hi, I'm Becky House from American Financial Solutions, a nonprofit division of North Seattle Community College Foundation. Today we're going to talk about two different types of scores, credit scores. There are many types, but we're going to limit the conversation to the two that people see most often and that most often influence lending decisions. These are the FICO score and the Vantage score. The FICO score is used in 90% of all lending in the United States. For most home loans, the only scoring model allowed is a FICO credit score. The Vantage score is important because this is the score we see when we use various free sites to access our credit reports. The score model is also used by many lenders who want to provide consumers their scores as a benefit or a perk of their service, i.e., your credit card company may show you a Vantage score as a benefit of your account with them. It is most likely not the score that they use to make that lending decision. In talking about scores, it's important to understand how they work. The credit score and the credit report are two separate products. They don't automatically come together. You can have a credit report by itself or a score by itself. But let's say that you apply for a credit card. The credit card company uses your Equifax credit report and a FICO credit score. The FICO model sits over the top of that Equifax credit report, reads the information, and spits out a number that shows how likely we are to pay our debts on time. So let's take a look at what needs to be in a credit report in order to have a credit score. For a FICO credit score, you need to have at least one credit-based account. That's a credit card, a store card, a mortgage, a car loan, a student loan, some other type of personal loan that's getting reported to the credit bureaus for at least 6 months. And that needs to be an account that has been reported within the last 6 months. A Vantage score is slightly different. You only have to have at least 1 to 4 months of history getting reported to the credit reporting agencies in order to generate that Vantage score. So let's look at how these scores play out. What you see on the screen are two credit scoring models. One is Vantage, the other is FICO. As you can see, they're very similar. Both have a range of 300 to 850. They do have slight differences within those ranges though. Again, it's important to note that we're talking about general FICO and Vantage scores. FICO has multiple scoring models for different purposes. The top and the bottom numbers are the same, but the ranges may vary by the model. For instance, there's a FICO Model 2, 4, 8, 9, and coming soon is the FICO 10 or X. Currently, FICO 8 is the most widely used model in lending, but even within 8, there are differences based on applying for an auto loan, a home loan, or a credit card. So let's look at how these models are applied to someone in real life. This is a woman that came into our office for help, and she brought her TransUnion and her Equifax credit reports that she obtained from a consumer site. Those used a Vantage score. Then we pulled her credit reports and saw there's a significant difference between the models. You can see that her Vantage scores were both in the poor range and her FICO scores were in the good range. The differences may not always be in this fashion. Sometimes the Vantage scores may be higher, and sometimes both the scoring models have similar numbers. That's why it's important to understand what generates those differences. So let's take a look. So as we said before, time is definitely a difference in the two models. The Vantage score, a 1 to 4 months of credit item reporting will generate a score. On the FICO score, you need to have at least 6 months. Credit inquiries, which we'll talk more about in a moment, are another factor. Credit inquiries stay on a credit report for 2 years or 24 months. Some of them have no impact on a credit score, but applications for credit do. On a FICO credit score, every credit card application counts against a score. 1 or 2 are generally not a huge issue, but the more you have, the more it can damage a score. Mortgage inquiries are grouped together. The amount of time someone has to shop for the best rate varies on the model of the FICO score, but it is generally between 30 and 45 days. All of those inquiries will be grouped together. Auto loans are the same way. Again, the amount of time varies, but it will be somewhere between 30 to 45 days. And private student loans are also grouped together with the same date range. Regardless of the score, though, all of the inquiries do show separately on the credit report, so you will still see them. On a VantageScore, whether you're applying for a credit card, a mortgage, a car loan, or other type of loan, those inquiries will be grouped together during a 14-day period. So if you applied for 10 credit cards during a 14-day period, those would be grouped together as one inquiry. Just remember that it will not reflect that way on a credit report that is using a FICO credit score to generate the number. The biggest difference between the FICO and the Vantage scores are how the scoring models use the data. So on a FICO credit score, when you pull your credit report, the score analyzes how you're using your credit right now. What does the available credit limit to credit usage ratio show? We want that to be no more than 30% or less of your available credit limit. On a Vantage score, the score analyzes how the person has used their credit cards over the past 24 months. Do they typically carry a high balance on their credit card, or are their credit cards usually paid off? For example, let's say that Sally has a credit card with a $1,000 credit limit. For the last year, she has carried a high balance, around $900. But the last month, she paid the card off in full. Her credit report shows her balance is zero. Her FICO score will likely be higher than her Vantage score because the card is paid off. The Vantage score will be lower because she has carried a high balance for the last 12 months. Okay, let's take a look at a few more factors in a credit score. Now, there are some differences between FICO and Vantage scores, but if all of these points are well maintained, no matter what your score is, you'll be in good shape. 35% of your score is based on your payment history for all of your accounts. Are you paying your bills on time? In order for a creditor to report that you are past due, you have to be at least 30 days past due on the account. 30% of your score is based on the amount that you owe. Do you keep your credit card balances low? And that is primarily what is being assessed here. So, if you have a credit card that has a $1,000 credit limit and you're using $900 of that available credit, that is definitely something that is going to drop a credit score. Again, you want to keep that at 30% or less of your available credit limit. Now, these two factors are probably the most important when it comes to a credit score. The rest of these, they do account, but they count for very little. So when we look at 15%, how long you've been using credit. Do you have a long credit history? And what is your average length of your credit history? 10% of your score is based on your applications for new credit. So this is limiting when you're applying for new lines of credit. And then that final 10% are the types of credit that you're using. So establishing revolving and installment accounts, so credit cards versus potentially auto loans or student loans, secured versus unsecured accounts, which again, you're looking at a secured account, which would be a mortgage or a car loan, something that you might lose if you don't make your payments, versus a standard credit card where it's unsecured, you can borrow, pay it off, borrow again. No need to run out and open up different types of loans. It is a very small factor in your credit score. We often hear from people worried about closing their credit cards because they've heard that it will damage their credit. The things to think about if you are considering closing a card are how will that impact your available credit to credit usage ratio. If it will increase the usage ratio, it may be better to focus on paying the debt down first. For example, if you have 2 credit cards and each one has a $1,000 credit limit, one card is maxed out, so you owe $1,000, and the other is unused. Right now, your available credit usage to limit ratio is 50%. If you close the card with the zero balance and that jumps to 100%, it's going to damage your score. If your goal is to increase your credit score and eliminate the unused card, pay down the card with the high balance first and then close the other account. The other thing to consider is will you have any other open lines of credit reporting to the credit bureaus? Remember, you must have at least one in order to generate a score. You may also consider how it will impact your average length of your credit history. Remember, the longer your credit history, the better. In some cases, closing an account has very little impact. But keep in mind, if you don't use the credit account, you run the risk that the lender will close that account. An unused credit card is a risk to the lender and potentially to you for fraud. Sometimes we recommend people use a card to pay one normal bill every month. That way, it's already something that's part of your budget, and you're not going into debt, but you're continuing to build positive credit history and improve your credit. The other common question is about building credit by charging something to a credit card and then paying it off in smaller payments. There's no need to go into debt in order to have good credit. Again, use the card for something that you already budget for and pay it off in full each month. That keeps the card open and your credit in great shape. Okay, we touched on inquiries, businesses looking at your credit report earlier, but we want to mention some of the inquiries that do not impact a credit score. They will show up in the credit report, but they're not negative. First and foremost, your own request for your credit report. There are numerous sites that allow us to access our reports for free, and these reviews do not count against us. Also, if someone offers us credit, such as a pre-approval, it doesn't count because we did not request the credit. If we sign on the dotted line and say we'd like to take them up on the offer, at that point it could trigger what is called a hard inquiry, meaning it counts against our score. Employment inquiries also have no impact on a credit score. Finally, if a company we already have an account with reviews our credit report to see how we're managing our credit and if they should offer us other products or services, this doesn't count. Again, we didn't ask them to do that. And this leads us into requesting our own credit report. Luckily, reviewing a credit report is easy to do. There are many websites that offer access to reports, but the most well-known and trusted is annualcreditreport.com. This is the site that was set up by the government so that people across the U.S. can access their credit reports for free at least one time a year. These comprehensive reports can be used to ensure the information in your report is correct, and if not, dispute the information directly to the credit bureaus, Equifax, Experian, and TransUnion. Annual Credit Report does not provide credit scores for free. However, they are available to purchase from each one of the bureaus. The other option is to access a credit report from one of the other free sites found on the web. Some provide credit reports and scores, however, not all sites are created equal, so we suggest researching sites before signing up. Look at other consumer ratings of the site, like the Better Business Bureau rankings, and do your own research regarding the reports, scores, and other services available. The list that you see provides an overview of some sites that provide credit reports and scores, and as this shows, there is a variance in the reports and the scores offered between the sites. Some important things to remember when you're visiting any of these sites. Most of them make money by offering other products or services for which there are fees. Some may be products offered by the site, such as additional credit reports or credit monitoring, but others will be financial products like credit cards and loans. Before deciding to use or apply for other services, be sure they fit your financial needs. Remember, inquiries to open new lines of credit do impact a credit score. Credit reports from annualcreditreport.com are typically more comprehensive than those found on other sites, so be sure to take advantage of these reports at least once a year. All sites are going to require that you answer identifying information about yourself to view your reports and your scores. And a note about those scores. In lending, scores are very important. As shown here, some sites offer a Vantage scores and other a FICO score. The most widely used credit score we know is a FICO score. If you're thinking about borrowing money, you will want to know what your FICO credit score is. Credit reports and scores are an important tool in protecting our financial health. Using one or more of those tools on the screen allow us to have information necessary to dispute errors that might be in our reports. Using the report, our budget, and other financial information, we can make informed decisions about our financial wellness. At American Financial Solutions, the financial health of our clients is mission critical. We hope this information is helpful as your success is our success. For more information, tools, and resources, or one-on-one assistance, contact us today.